and welcome to the Tearsheet Podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tearsheet Editor-in-Chief, Zach Miller. And in today's financial landscape, we talk a lot about innovation here on this podcast, and it's more than just a buzzword. It's a driving force separating industry leaders from those left behind. Finding, nurturing, and scaling the right technologies has become a specialized skill set all its own. Joining us today is Ryan Falvey, co-founder and managing partner of Restive. Ryan has spent the last 15 years at the forefront of identifying and championing market-changing innovations in financial technology. His track record is vast. Since 2015, he's invested in 40 early-stage fintech firms that have collectively grown to represent approximately $3 billion in aggregate equity value. And before founding Restive, Ryan led the development of the Financial Solutions Lab, a partnership between JPMorgan Chase and the Financial Health Network. And his experience also includes developing payment solutions with leading tech companies at Silicon Valley Bank. Today, Ryan joins us to share his perspective on how fintech innovation is reshaping financial services and what industry professionals should be watching for in this dynamic environment. Welcome, I should say, back to the show, Ryan. We spoke the last time in 2021.
Yeah, well, thanks for having me. I'm excited to be back.
Maybe that's a great way to start. We did touch base in 2021, hearing about what you were working on then. I mean, it's been a wild 4 years. What has changed since, over the last 4 years? This was in the midst of Corona. Things were shut down. Things were moving to digital. Maybe catch us up to where things are today in your world.
Yeah, I mean, that's interesting because we probably spoke at the absolute kind of high water mark of, fintech. 2021. Yeah, it was kind of the year I remember, you talk to other investors and we'd be like, man, we just should have done all the deals in the last like
shooting fish in a barrel. Yeah.
Any discrimination in selection was a negative bias. And then, things obviously changed really dramatically starting kind of in 2022. And I think to a degree, continuing kind of to the present day. Yeah. There's certainly been a shift in sentiment of fintech more broadly. And then I think also, kind of a shift in sentiment, kind of increasingly a little bit away from tech too. So it definitely kind of feels more like kind of back to basics in what we're investing in and how we're working with the founders. But at the same time, I'll say a lot of that, we are investors in companies, and so the main thing we're looking at is what's the underlying performance of the companies, and what are these businesses doing, and are they making money, and how much money are they making, and how quickly are they growing? And what's interesting and surprising is at the company level and at the portfolio level, it's literally never been better. I mean, we have companies that are growing much faster and making more money earlier in the life cycle than really ever in my investing career, going back into over a decade now.
What vintage would those companies be? Are those the more recent investments? Or those can you be more specific with that?
Yeah, I mean, honestly, I can tell you the date that things change, and it's January 1st, 2023.
Wow. Okay.
It's really looking, and I think it's really the impact you had of a lot of these new kind of, LLM models and kind of these AI-driven tools, especially on the coding side. It's just dramatically accelerated how quickly technical startups can develop product and iterate, try new things, and kind of push their vision out into the world. And the faster you can move in a startup, the more things you can try, and the more kind of shots on goal you have, and the more ways you can improve on a product once it starts working. And just to give you a snapshot, I mean, the investments we made since the beginning of 2023 now make more money in aggregate than everything we did in COVID combined. And there's probably half the companies. The ones that are driving the revenue in that kind of COVID cohort are the most technical founders, like the strongest, technology solution. And there we're seeing a similar dynamic. They're raising, very little follow-on capital. They're running really lean teams, getting to profitability much earlier. And so it's actually a really exciting time to be investing at the early stages. Because we are really seeing a total phase shift in technology and how these businesses are being built and how big they can get.
Given that dynamic on the front end and I guess the growth cycle, do you think it'll impact exits as well?
Yes. Yeah. I mean, I think we're already seeing, it's, yeah, I don't know when you're going to air the session, but it's early April right now, and we're seeing there's a number of kind of fintech companies that expect to go public here in the next they've kind of listed so far this year.
Yeah.
The public fintechs have generally done relatively well over the last year and a half or so. So I think there's definitely a shift, kind of an appetite there in the late stage, and we'll probably see more come. The stuff that we're investing in now. I mean, many of these businesses are probably still, 5 years away. Yeah, they're ways away from going public. And you tend to see mergers at this stage more and more frequently, or acquisitions. And I say that what we've seen on the acquisition front has been pretty robust. But I think the best companies are probably not going to be acquired. They're going to continue to try to grow, and I would expect them to be. I expect us to be seeing some really significant businesses being built kind of in this current era.
Awesome. And how have thematically, how has investing changed? I guess since last time we spoke, 2021 till today, like. What kind of themes are you looking at in the portfolio? What's exciting to you?
Yeah, I mean, we're seeing a number of things. I mean, the big thing would be tech. Like, I can't
Yeah, you're probably not investing in big generic plain vanilla neobanks, right?
Yeah, we're investing in technology companies.
Okay,
and that is, and I think to a degree, we raise money ourselves. We explain to our investors, we're investing in technology companies who just happen to be in the financial services industry, and I think that's a real shift from 21, where people are like, oh, we just need digital stuff is going to take over. So if it's online, it's going to be better than being offline. And you had just this incredible growth of a lot of the businesses that existed, and we're strong. But it wasn't like, hey, there's a completely new technology here. And I think now we are seeing some truly new kind of technology innovations that are allowing founders to build entirely new approaches to financial services. And I'd say there's kind of like 6 kind of big categories where we're seeing a lot of activity. One is obviously generative AI tools. The biggest impact there is actually probably within the startup. I like to say that the best use case of AI is creating a company, because if you have to create a bunch of stuff, tools like ChatGPT and Claude and coding assistants like Cursor are incredibly helpful to create that stuff more quickly. A lot of the crypto infrastructure that kind of got laid down over the last couple of cycles is now pretty useful. There's stuff out there that's allowing for kind of agentic payments and ways of kind of just automating kind of background kind of purchase and inventory management systems that have come directly out of crypto. You have a company in a portfolio called Crossmint that basically does that. Allows it was originally a lot of infrastructure for NFTs and is now being used to basically just kind of automate. You can automate payments and just kind of set these kind of agentic payments to kind of run in the background. We're seeing, I think, the service industry, particularly around consulting, law firms, anyone who is making a lot of money by creating paper, tax prep. I mean, those industries are under serious threat. And so we're seeing startups there that are just growing at unbelievable rates. In large part because they're able to create
just that advice layer.
So in finance, think about financial services and say you have services and then you get a license from the government to do the finance part. And a lot of those services, you're doing something that has an audience of one or an audience of maybe nobody. You're just creating paperwork that sits on a shelf in case someone wants to see it in the future.
I see.
Think about the Iron Mountain. Literally, there's a mountain just full of paperwork that someone might need in the future.
Paper, yeah.
Yeah, how much did all that paperwork cost to get created? And it was a lot. And if I can spin up it an AI engine that goes and generates that paper, and it takes 5 minutes instead of 5 months, that's a huge cost savings. And there's a lot of parts of the financial service industry that just create paper. It might be, might be support you need for a credit decision that you're already going to do, but you need to go collect all that. I mean, if you ever got applied for a mortgage, great example. There was like tons and tons of paper associated with that. It's all there for a reason. It's all important in certain circumstances. It's not necessarily all important to be done every single time by a human being. And so if you can find ways to kind of make that process automated, it's really valuable. Think about really expensive law firms that are reviewing. A law firm might be reviewing multiple 100-page long documents associated with an extension of credit to a company, or the covenants that go back and forth. A lot of that's boilerplate. It's there for regulatory and legal reasons, and you're still, every time you're doing one of these deals, you might be paying millions of dollars to a fancy law firm to review all that. We're seeing those types of the business kind of get commoditized down very, very aggressively and very quickly. We're seeing new technologies, like kind of horizon technologies, are going a lot faster than people give credit for. There's a lot of advances in quantum. The first kind of use cases of that will be in financial services. Increasingly personalized and really intelligent ways of thinking about commerce. So we have a company in portfolio called Isle. It's really interesting. They essentially connect brands directly to consumers. So instead of you see an ad right now for Red Bull or something online, and then maybe you go buy a Red Bull, and then Red Bull kind of has to figure out, well, did the ad
did it work, right? Yeah.
What happened here?
Attribution models, all that stuff. Yeah.
Well, now this company allows Red Bull to say, hey, go buy a Red Bull today, and we'll just pay you back. And in exchange, the consumer gets a free Red Bull. That Red Bull gets to know exactly who the customer is, where they live, where they shop, and starts to. It's
like acquiring a customer post-purchase in a way.
Yeah. And you know who they are. And
very cool.
That's a really good example of going to kind of the future of commerce, where it becomes a lot more personalized, a lot more specific, and I think a lot better, kind of across the board.
Are you seeing anything? I mean, given your background, at the Financial Solutions Lab, what's happening in sort of the social world within financial services? Have you seen companies grow there or make an impact?
Yeah, certainly. I mean, I think when I started my career, I started an accelerator that was backed by JPMorgan Chase in partnership with a nonprofit. And so we were very focused on kind of very consumer-friendly financial services innovations. So we were investors in a company called Dave.com, which eventually has now gone public, and to help consumers avoid overdraft fees. That's probably a really good example.
Been on the podcast a few times. Yeah.
Okay, cool. Yeah. That's a really good example. I mean, I think we're that as a public company, he had a little bit of a roller coaster ride. And over the last year was the best performing stock in the Russell 2000.
He built a real business. Yeah.
And I think that goes to show that if you
off of $100 advances, right? Yeah.
If you have a solution that really helps people, there's a lot in that. I mean, I think it's been, you haven't heard as much about them because I think the investment community has gotten more concerned about kind of consumer businesses at large. I will tell you, as an investor in a number of these, because almost all of these businesses are going to be consumer facing, right? You're helping low income people or more moderate income people do something, you need to acquire those people, you need to serve those people. There's regulatory, historically, there was regulatory kind of issues associated with we're serving those people, and so that was one category that was really kind of hit hard, kind of in that kind of post-COVID kind of fintech crash. Again, underlying company performance though is doing extremely strong, and Dave is a public company, and so anyone can see that that company grew throughout the last couple of years. It became profitable, as you said. It kind of created a real business, and we're seeing that kind of across the board. So I think investor sentiment will probably catch up, and you'll probably start hearing more about those types of solutions. I'll tell you that is one area where where a lot of these generative AI tools are actually going to have a real big impact, I think, on customers.
How so?
Positive. Well, we have a company in the portfolio, it's a small firm called Chargeback, and we basically look at your subscriptions. Rocket Money has a similar solution to this too. They kind of look at your subscriptions, look for things that you can cancel, and kind of proactively go out there and try to save you money, cancel subscriptions you might not be using, and really just kind of out there looking for how to save consumers money. Well, the ability to that service, and I'm sure that with the team at Rocket has also made just dramatic improvements in what's possible there, because I'm no longer just looking for Netflix to show up for $13.99 every month, and these tools can go through and say, okay, what are you actually using? Like, right. I can look at I can connect your browser history. Like, maybe you are getting a lot of value out of Netflix. Maybe there's a service you signed up for that you really should cancel, or maybe you bought something and you should have got a refund because they violated the terms of service and you didn't know. And that is a level of sophistication beyond where you saw before. I read something. This is kind of off, not really fintech, but I read something somewhere of some business that was basically taking advantage of these individual arbitration clauses, like forced arbitration that everybody has been forced into. Like, whenever you sign up for something, you basically agree to just binding arbitration. And the reason the companies do that is because the most you're going to win is $100. And I think this company was going at basically just doing this at mass scale. So instead of Disney, getting to fight you over $100 and it's not being worth it to you, they're fighting 1,000 fights for $100 across the country, and it's more expensive than a lawsuit would have been. And so that kind of stuff, it requires just a huge amount of technology to do that. But I think you're kind of going to see more of that in the coming years.
Got it. Maybe we could talk a little bit more about Restive. What's the investment thesis? What kind of companies are in your sweet spot? Tell us a little bit about the fund.
Yeah. So we're early stage technology investors. Our goal is to really be the first money into the companies and founders we back. So we like to say, nothing's too early for us. And we are probably the first capital into many of these companies, from probably about a quarter to 30% of the time, and then the majority of the time we're going to be kind of pre-seed investors, and so that might be a founder that's raising, let's say $1 to $3 million. Probably might be pre-product, might be a couple months after rolling out a product, so probably earlier than you'd assume for kind of product market fit, but typically we can get a sense of what they're doing, understand what their vision is, and you might be a team of 4 or 5 people is kind of on average. And our strategy is to write relatively small initial checks. So our first check is about $500,000 into most of these companies, and then we work really closely with the founders to really help them to connect them to the broader financial services industry. So, like I said, we're looking for technology businesses that just happen to touch the financial service ecosystem. So they might want to sell into them, they might want to handle payments, they might want to access financial data. And so we can bring a lot of that expertise to the companies, and what we find is that can really be transformative to the best teams. And then we'll look to really kind of dramatically build on our positions in these companies very quickly and grow and scale with them as they grow their businesses. So we're pretty high frequency investors. We're investing about once a month. We'll find a deal we like to do. And at the outset, I think we're actually probably close to about 80 portfolio companies at this point. We're now investing out of our third fund, and we're all former fintech founders and operators, and so we really pride ourselves on being able to really try to become an extension of the management team, and hopefully open up doors and kind of take things off the plate of the founders we're working with, so that they can just move faster and grow more quickly.
Does that take a certain type of founder who wants to collaborate at that level? I can imagine some are very collaborative and others, I guess may be less open to investors helping to contribute on that level, or not. I mean, I guess it's a question.
Yeah. I think most founders want help that's helpful.
Right.
They're resistant against help that's not helpful. So we do try to be
that wouldn't be called help, right? Exactly. Yeah.
But can I help you with this podcast? You're probably not. They don't really know anything about the Like, you can sit there and like, have a quiet room you can sit in. That would be the most helpful thing. Like, I'll need you with the dials. And so we're helpful in really specific ways. We're helpful in helping connect you to the financial service industry, helping if you need to figure out like a complex issue around legal or regulatory dynamics, or you need to expand your network to sell and do more partnerships. If you've got a business that's going to need to raise a lot of money, our model is to connect our founders to downstream investors, and we spend a lot of time helping them build those relationships. And so, if for say, not to bring it back to Jason and Dave, we're one of the first investors in that company, helped connect them to Series B investors, and continue to be investors in that company now. So we really see this as a really long-term relationship, and try to be helpful in a way that's going to be constructive to the relationship, and are going to get out of the way, or we're not. So we generally aren't taking board seats. Because our view is we're really good at kind of pre-seed and seed, not super good at like Series D, and like the decisions around going public. Like I don't have great advice on who your 18th engineering hire should be. But there are investors who are really good at that, and those people should be on your board. The business should reflect where it's at in its life cycle. And so we're very focused on the part of the market that we sit in, and I think we're probably some of, and hopefully the most helpful investors to our founders at that category. What we found is most founders are quite appreciative of that support, and they're trying to build big businesses, and there's a lot of talk of the $1 billion startup with one person. I haven't seen it yet.
Yeah,
we certainly have a number of $1 billion startups that have many people in them, and managing other people is hard and requires a lot of people helping out to get there.
Yeah, we've recently had a lot of the unicorn fintech founders or CTOs on the podcast, or CPOs, chief product officers. Yeah. And that skill of being able to go to scale to that size is not trivial. I mean, those guys are freaking amazing. And in terms of geographic focus, are you focused on the U.S., I assume?
Yeah, pretty heavy focus on the U.S. Yeah. We have companies outside of the U.S. market, but this is the market we know well. And going to your earlier point, I mean, we stick to what we know and where we think we can have a big impact. From an investment standpoint, this is also like the U.S. financial services industry is maybe outside of big tech, the largest pool of revenue and profits in the global economy. Mm-hmm. And it's a pretty dynamic one where, if you have an interesting idea, you can very quickly get a lot of them. And so we think it's a pretty good place to practice venture.
Agreed.
For sure.
Question for you. So sitting in your chair on this podcast, we have a lot of chief technology officers, chief digital officers at a lot of the largest U.S. financial institutions. And one of the things we talked about over the past few years is their ability to partner with companies like in your portfolio. How have you seen that evolve? Like are financial institutions, the help that you're trying to give to your portfolio companies, like break in to sell into financial institutions, the ability to partner, the ability to collaborate, big versus small, different time frames, speeds, how have you seen that evolve over the past few years?
It's gotten, I think, a lot more constructive for startups.
Okay, great.
And I think in kind of two ways. One, there's I first started investing in 2014, 2015. I was working very closely with JPMorgan and very small startups, and I'd say it was a pretty common view that this will help us to partner with JPMorgan, and we'd have to be like, no, it's not. They're and that's not the case anymore. I think there's a lot of smaller financial institutions and banks in this country, mm-hmm. and across the board, and also large fintech companies which has totally changed the dynamic of partnership. So if you're just starting out and maybe you're a seed stage company, you've got a product in market, you can go and find stage appropriate partnerships, whether that's maybe if you're handling payments, there's banks that will do that. If you're looking to kind of sell into larger incumbents, there's kind of smaller larger incumbents that will buy the product and test it out. And I think that the kind of, let's say, the mid-market category of financial services businesses that might do 50 to a couple $100 million of revenue they're actually very smart now on technology, and there's a whole more than I know that would be excited to partner with startups at almost any stage in any category. And then I think the larger financial institutions have also gotten very sophisticated, and for the most part, in how they engage with startups. Many of them, the venture capital programs, the internal ones that they started, maybe a decade ago, now are actually very sophisticated, really well-run organizations that behave, quite similar to VC funds. Mm-hmm. And so they're looking for investments that are going to make money for their companies, and also where there's a strategic element, but they're much smarter. I don't say that's not the right way to do it. They become a lot more realistic on how this partnership can work, and what the constraints that they the limits of how much a startup can affect their business, and how their own business could affect the startup. And so I think it's actually, again, going back to, this has actually been a great couple of years in fintech, because it's a much more constructive environment for those partnerships. I can remember horror stories, a decade ago, where a startup would start working with a big financial institution and just get
the death
valley of partnership meetings and pilots and all those kind of stuff. And you just don't see that as much anymore.
Awesome, Ryan. It's been great catching up with you. I hope we speak again sooner than another 4 years, but wish you the best of luck in the portfolio. And this has been a very constructive conversation.
No, well, thanks for having me. It's fun to chat with you, and I'm happy to chat whenever. It's a lot of fun.